Traders, why do you limit your gains with spreads, especially on a binary event like this biotech stock that was up 300% CCXI? I don't understand why you're capping your gains. When you're buying call spreads or you're buying bear put debit spreads, if you think the stock or the market's going to go lower, why are you capping? That's right, capping your gains like this, trader. I don't understand why they missed out on millions of dollars by buying a call spread instead of buying outright calls. Let me show you. So CCXI, the stock went from about $7.85 to $36+ overnight on good news on their drug approval there. So biotech stock. Okay. But on 11/18, so let's actually go to our Analyze tab. We can go to the Think Back feature. Again, I like having all my data, all my notes, everything set in the options market. So we can see here, and this picked up too as an alert, the December 10 calls, these were bought on the ask. I think they paid, officially they paid, let's go here, they paid $245, and then, so let's put that $245. So they paid $245, right near the ask, right? And then they sold. See, we have 4,000 here. They sold the December 15 calls, so they got that as a credit, and they did that for, let's do the math here. Let's see how much they got. 85 cents. So they did a bull call spread here. So they got 85 cents. So a total on that trade, if you take 245 minus 85, we can actually see the debit they paid. So what's that going to be? 0, we'll cross that, 14, 6, 160 they paid as a debit. So their max loss on the trade is 160. Since it's a $5 wide spread, their max gain will be 5 minus 160 is 340. And they did that about 3,000 contracts here, about 4,000 actually, but when I saw the trade it said 3,000 in size, so maybe they did an extra 1,000 in there. So their max gain is 340. So if we do the math here, let's pull out a calculator here. We'll just stick with the 3,000 size. So they did 3,000 contracts, and their max gain on the trade, they paid 160. Their max gain on the trade will be 340. So we'll times that by $340 per contract. So that's a little over $1 million in profits. So 1 million we'll say in profits. Now this is what I want to show you, and this is why spreads are absolutely just horrible in some cases, like in this stock. Okay, but this is I have to show you this. Those December 10 calls with a stock at, let's just say $35. Obviously, you're not going to be perfect and sell at $36.88. So let's just say $35. So those calls are worth $25 at one point. $25. So let's do the math a little bit here again. Let's go ahead and say those calls are now $25. $25. They did that 3,000 times. So that's $2,500 per contract 3,000 times. Let's look at this here. Come on, pull it up here. Oh my goodness. Are you ready for this? Are you ready for this? $7.5 million they missed out on. $7.5 million they missed out on by capping their gains by selling that December 15 call. That's why call spreads, in some cases, can limit gains so much that if you're a trader, and I've been in this situation before, you're just shaking your head saying, why? I could have made X more money if I would have limited my gains. Now again, the positive is you're collecting a little bit. You're collecting that $85 per contract on the upside. But again, your gains are capped when you spread out a trade. So next time, Just understand your risk, obviously, when you're trading. But if it's a binary event and you think the stock can absolutely move, maybe they were only looking for 100% gains in that stock CCXI. That's it. But the stock went up over 300%. Wow. Let me know your comments in the video below. Shoot me an email. I am just stunned.